Good morning. Let me welcome you all, both here in the room and online, to this new edition of our lecture series organized by the Chair Macroeconomie Internationale here at the Paris School of Economics. And as usual, we are of course very grateful to the Banque de France for this partnership that enables us to promote, but also hopefully at least jointly produce state-of-the-art macroeconomic research and thereby maybe a little bit to contribute to solving the macroeconomic policy challenges that the world faces today, and there are surely many of those. Today's lecture is a little bit special because not only is our guest an eminent academic researcher, but also one of the key policymakers in Europe today. So I'm very excited to welcome Philip Lane, member of the European Central Bank's Executive Board, and I think still a little bit professor of economics at Trinity College, Dublin. I'm also very happy to welcome Agnès Bénassy, who is my predecessor in this job as the director of the chair and a little bit my role model in doing this. She's also, of course, my esteemed colleague here at the Paris School of Economics, but currently she's on loan, to use language of the football transfer market, to the French Treasury, where she is chief economist. And Agnès kindly agreed to introduce Philip and to be in charge of the proceedings today. But before I give the floor to her, I think Daniel Cohen, the chairman of the PSE Foundation, would like to say a couple of words. And I think he's the person in the room that knows Philip the longest.
No, I really want, I will leave it to Agnès to formally introduce Philip, but just wanted to warmly welcome Philip. It's really a great pleasure. It's a great honor. As Tobias mentioned, I think I've known Philip from his very early days as a macroeconomist at the time when we would meet in Tarragona in Spain in bathing suits. And we were there at the time. There was also an oncoming central banker, Axel Weber, if you remember. And he also he also came to give us a lecture at the time when he was elected. And so I remember all these days, Philippe, with warmth and recognition of all that you have done. And we've all followed, I think Richard Portas also must have been very proud. We've all followed how you evolved into a policymaker, and today at the highest possible level for a macroeconomist in Europe as a chief economist. So thank you so much. I really look forward to hear for your speech and the pleasure of meeting you again. So it was just my way of, again, thanking you for coming with us, and I leave it to Agnès to formally say.
Hello, everybody. So it's my great honor and pleasure to welcome and to introduce Philip Lane. We've known each other also for a long time. When you were an academic professor at Trinity College Dublin, specialist, very well-known specialist of international macro, hence the invitation by the chair. So today we have the two elements in this lecture. And in a sense, you are also my role model because you moved into 2015 from academia to the Bank of Ireland, Central Bank of Ireland, where you've been a governor of the central bank during 4 years before moving to the ECB just before the pandemic. So this is already your second crisis in just three years. So we are very much interested in what you're going to say today. Just for the record, for the audience, Philip holds a PhD from Harvard, and he is a very productive researcher already. Still today, I think from time to time you find the time to publish. So Philip has published many articles in top-ranking journals, especially in areas in international macro. And so I will just mention three areas. One, which many of you probably know, is the work with Gian Maria Milesi Ferretti, the very famous External Wealth of Nations, which is a novel database which was first published in 1999 and then updated regularly. I think the last update was in 2018. And so you can find it in the IMF Economic Review. And around this idea of external wealth of nations, you've been working on currency exposures, valuation effects, and also, of course, current account imbalances. So very important work in this area. Second area, more recent, is around the debate about the sovereign doom loop, where you've been very active, first as an academic with other authors. There is a paper in, I think, American Economic Review in 2016 around the idea of SBs. And then you chaired the ESRB high-level task force on safe assets. Which produced a report that is kind of landmark in the debate, which has been stopped. Maybe it will recover later on because we had this pandemic, and then the NGEU framework, which is a different way of issuing safe assets. Third, and then a number of areas where you've been also active: cyclicality of fiscal policy, exchange rates, the Irish economy, and also emerging economies. So I will not follow up. We need to save time for the lecture. So today, Philippe is a member of the executive board, but not only a member of the executive board, but the chief economist of the ECB. As such, in charge of two GGs, economics and monetary policy. And I think you are the one who makes the initial monetary policy proposal at the Governing Council based on a very detailed analysis of the economic situation in the euro area. So I recommend all the students here to have a look at the ECB's website, where you can find all these analyses, which are so here we can see that the professor is still there and showing the data in a very convincing way with so it's data based on data and based on research. So this is very valuable, and we welcome you again here. Thanks for being with us. The floor is yours.
Good morning, everyone, and thank you for the very kind welcome. In fact, my first area of work in economics was on external debt. So the work that Daniel had worked on with Jeffrey Sachs and in different formats when I was doing my PhD in the early 90s. A lot of this was Daniel Cohen. So it's very nice to see you today. And of course, having moved from academia to central banking, and I know for the students here, in the end, there's a very high degree of similarity. Most of our days are spent looking at economic research, looking at people doing applied international macro. And so there's a very high crossover. Of course, I'm sure there's many graduates from the Paris School of Economics already at the ECB. So today is March 31, which is the final day of the PEPP program in this context of net purchasing of assets under this program. So it just seemed to me maybe good timing today to focus on the last 2 years. So the pandemic, of course, arrived very suddenly in early 2020. In terms of our big decisions, the PEPP program was decided on March 18, if I'm correct, in 2020. So just over 2 years ago. And so it's a good time to review the last couple of years, but also, of course, now that we have many problems now, after, even when the PEPP program is finishing, to also address some current issues. So maybe in terms of the pandemic, there's many ways to try and capture the pandemic. And what this graph shows you is two indicators we look at. One is intensive care unit admissions. I mean, it's not so useful to look at cases. because there's clearly a huge underreporting of cases at the start. I'm sure there's an underreporting of cases now as well. But the case number doesn't tell you maybe quite as much in terms of the pressure on the health system as intensive care admissions. And so what you see there is this really going from basically zero with COVID to a huge spike at the start. That's what kind of prompted a lot of lockdowns of economies and so on. Then as the virus got contained, and then we've had waves and waves and waves, you see what's been happening. Now, economically, we think about, okay, how does that affect the economy? There's all sorts of mobility indicators, basically people not leaving their house, people not doing normal economic activity. And this is an inverted scale. So a bigger number in the blue line means less mobility. And you can see, again, going from being unrestricted to massively restricted in spring 2020. And then we've had these waves, including, over late last year, early this year, and now it's been relaxed again. Again, this is to be repeat, it's a mixture of whatever government restrictions have been in place. But of course, a lot of this is voluntary. People choosing, saying, legally, I might be allowed to go to a restaurant this evening, but I prefer not to. So there's also that element of it. What I don't show here is if you try to say, okay, how much of that mobility is affecting economic activity? It affected economic activity a lot at the start. Over time, we learned how to work from home. Over time, we learned how to do online shopping. So there has been a lot of adaptation. So this mobility index is not a one-for-one predictor of the economic damage, because over time, we did learn to get around some of these restrictions in terms of economic activity. Just think about all the different ways we work and consume today compared to 2 years ago. Okay, so the at that start, when you have something unexpected and sudden, and especially when at the start, and I'll come back to this, there was kind of a lot of fear that this would be something that would really devastate the world economy for a long time. At the start, there was a big kind of pressure on financial markets. Because of course, financial markets are forward-looking. They kind of anticipate not only is there a hit today, but maybe into future years, the earnings of firms will be lower, the demands on governments will be greater, and they reprice financial assets. So I'm not overly dwelling on I don't have too many charts on that today, but essentially in response to that, central banks around the world had basically a dual function. One was to stabilize these markets rather than having widespread instability, banks failing, lots of bankruptcies. There was an imperative for central banks to intervene. However, the second function was we also could be confident that there would be a big slowdown in the economy, and therefore there would be downward pressure on inflation. And because of our desire to keep inflation around 2%, we would need also to have a loosening of monetary policy, not just for a week or two, but for a sustained period in order to make sure inflation pressures did not become too weak and spill over into deflation. And so the first slide I'm going to show in terms of what happened is, and here I just picked three central banks, the Eurosystem, the ECB, together with the national central banks, then the Fed and the Bank of England. By the way, again, just a reminder, the reason why I say Eurosystem is ECB is in Frankfurt, but actually most of the activity is executed through the national central banks. So when we say we bought assets under the PEPP, a lot of that purchasing was here in France by the Banque de France, and so on in each country, with the ECB also playing its part. And so what you see here is essentially, in terms of the blue bars, are asset purchases. So central banks buying government bonds, corporate bonds, commercial paper. And you might say there is ballpark quite similar. Over the last couple of years, maybe between 15 and 20 percentage points of GDP. But in fact, the euro area was a little bit less than the Fed and the Bank of England. So that's important to note, is that this is not something that's unique to the euro area. It was basically a recipe that central banks around the world, it was also true, by the way, in many emerging markets, that they were intervening to stabilize markets. Maybe what's interesting, and again, as a reminder of the way the European financial system works, is because we have a bank-based system, it is important also to make sure that banks had reasonable funding so that they would be able to maintain their lending to firms and households. And so the orange bars are credit operations. So this is basically providing funding to the banking system to lend to their customers. So in America, banks are relatively less important. The Fed tends not to do too much by way of direct funding of the banking system, whereas both in the UK, but even more so in the Euro system, this was a big part of it. And this is what we call our TLTRO program, targeted long-term refinancing operations, which is a bit of a mouthful. The target in it means we will provide funding to you at a cheap rate, but the target only if you meet the target of maintaining lending to your customers. So this is a very important way to make sure that that credit was uninterrupted in the pandemic. So it's important to, here I focus on interventions in terms of purchasing bonds, and also interventions to provide more funding to the banking system. So you might say, hold on a second, I thought central banks worked by setting the interest rate. So behind all of this is also what's going on with interest rates. So in the euro area, interest rates were already low before the pandemic. In September 19, we had lowered them to minus 0.5. It's kind of annoying to say minus 0.5, so we talk about basis points, and minus 50 basis points. So we already had a low policy rate. And again, the recipe when you have low rates is you try and maximize the influence of these rates by forward guidance. You say, we expect to keep interest rates at these levels essentially until inflation pressures pick up. So then one way the monetary conditions are influenced is if the market believes inflation pressures will be weak for a long time, they believe we will keep rates low for a long time. If the market believes that essentially inflation pressure is picking up, they think even if we don't raise rates today, we will raise rates sooner rather than later. So in this graph, what I show you is when did the market believe we would raise rates? So in September 19, when we lowered rates, they actually believed it might be 2027 or 2028 before we would lift interest rates. So there was a prospect of 7 or 8 years with basic interest rates remaining very low. Then there was some improvement in activity in the autumn 19. And so if I focus on the blue line, which is when are we going to raise rates by 10 basis points? By December 19, it was, okay, maybe it's 3 years before you do it. Look what happened next. When the pandemic hit, there's such pessimism. They believed they went from maybe sometime in 2022 in December to sometime in 2027 in March. So they added 8 years of low interest rates in response to the pandemic. So this is basically the market believing this is not just an episode that's going to have a kind of a very short-term effect. It's an episode that will mean the ECB will keep rates low for many years. And then you can see over the course of the pandemic, the mood fluctuated. But maybe I'll highlight from autumn 2020 onwards, it's basically with some bit of a wobble last year. It's basically trended downwards. So in autumn 2020, it was hovering around 2026. So they believed we would not raise rates until 2026. But essentially then the vaccines came. Autumn 2020 was fundamental because we got the good news that vaccines were on their way. And basically over the course of the last year and a half, it's come back. And by autumn last year, the belief was it would be sometime maybe in 2023 that we would start to raise rates. Of course, it's further pulled in because of what's happened since then with the new energy shock. But I'll come back to that later on. Okay, so then what is the context of the pandemic? Why was it the case that the ECB and other central banks felt it was important to enter the bond market? This is adding up across all types of bond issuers. The government, corporations, banks also issue bonds. So this is the universe of who issues bonds. And look, it was pretty stable before the pandemic, something around 250, 300 billion a year net was being issued in Europe. Then it went from something like, it may not be the exact number because I'm just reading the graph rather than a number here. Let's say that was 300 in 2019, is close to 1,500, 1.5 trillion in 2020. If you were to ask the bond market to absorb that change in supply of bonds in 1 year, I think the textbook would say there'd be upward pressure on interest rates. If there'd been upward pressure on interest rates in 2020, just imagine the implications for the ability of firms and households to get through the pandemic. And by the way, even now, even though it's come down quite a bit in 2021 and even more so this year, it's still not back to pre-pandemic levels. So essentially the assessment was, unless the ECB would step in, there'd be a lot of upward pressure on interest rates. And in the middle of a pandemic recession, it's maybe not the time you want to have a lot of upward pressure on interest rates. So this is essentially what's happened. The blue bars, and here I focus on the four biggest countries. So it's not everyone, but it's easier to track France, Germany, Italy, and Spain as a collective. You can see there was some increase in the blue bars, which is our standard asset purchase program that was already running. And then the orange bars are the addition of the PEPP. So we definitely we're doing a lot of purchasing. The two lines, the red line and the green line, if my colors are correct, tell you what share of bonds is held by the ECB. And it went from about 19% at the start of 2020 to about 30% now. So there has been an increasing share of bonds bought by the Eurosystem, but most bonds, the vast majority of bonds are held by the private sector. So again, sometimes you hear, oh, the bond market has been taken over by the ECB. We've definitely been busy, but in the end, it's still the case. By far, the majority of bonds are held by the private sector. So when you think about the pricing of bonds and so on, it's still a dominant role for the private sector, and that's very important and appropriate. So here's the month by month. And so what you see at the start, there's a lot of purchasing. So the monthly rate in spring 2020 was well above 100 a month under PEPP, and taken together, probably 140, 150, numbers like that between the two programs. Remember, pre-pandemic, the annual total was maybe around 300. Month by month, we were buying so much. Pre-pandemic, we were buying 20 a month under the APP. So go from 20 a month to 100 and something very quickly was quite a change. But maybe importantly, what you see is after there was an initial stabilization. So there was a stabilization in the bond market. Once the market knew we would be a steady presence in the market, how much we actually needed to buy came down over time. So again, this is always this dual role. There's an initial role to stabilize the system, but even after you've stabilized, if the economy is weak compared to its trend level, and if there is a still weak inflation pressure, there's also more of a longer term campaign to keep financing conditions favorable. So one of the questions, one of the important principles was, at the time, the pressure in the bond market was not uniform across the euro area. Because of course you have some countries which have higher debt than others. But with the pandemic, it was hitting essentially the tourist economies much more than Northern Europe. Because of course the immediate implication of shutting down travel was that tourism would be the hardest hit sector. And so immediately there was this asymmetric pressure that basically the tourist economies would be hit much harder than some other economies. So what's interesting is that the capital key is basically how important is each country in the size of the euro area. It's basically proportioned to GDP. So of course the Germany is about a quarter, just over a quarter of the euro area, and you can see it around the smaller countries. And what you see that the diamonds are the yellow diamonds are kind of at the peak of the pressure in spring 2020. The red diamonds are where we are more recently. And what you see is, in the end, the overall purchasing temporarily in spring 2020 was skewed towards the countries under most pressure. But in fact, that episode didn't last that long. And in fact, we were able to implement monetary policy on a fairly uniform way thereafter. And so you see where we are now in terms of the share of each country in the portfolio is quite similar to their share in the capital key. Okay, so then why do we purchase bonds? I mean, the way it primarily works is essentially through the impact on interest rates. And of course, in the short term, interest rate is tied down by our other policies. But the longer term rates, for example, the 10-year bond rate, a lot of bonds are issued around the 10-year rate. What you see here is that before the pandemic, during 2019, globally, there'd been a decline in long-term rates because essentially the world got more pessimistic about the future. So at the start of 2019, the kind of risk-free rate in Europe, the overnight index swap rate, is just kind of the rate essentially financial institutions trade with each other at, what was plus 0.5. In 2019, so before the pandemic, it fell by a full percentage point to minus 0.5, more or less. So that, and again, like I said earlier on, there was a degree of improvement in optimism in late 2019. So it come back closer towards zero. So what you see is essentially what happened is in 2020, when there's a lot of concerns about the pandemic, the interest rate was basically maintained stable, close to minus 0.5. Throughout 2020, it was basically, after the initial volatility in March, it was basically a flat line in the grand scheme of things for 2020. From late 2020 onwards, when essentially the prospects got brighter, the vaccines were arriving, people were understanding eventually we would get out of the pandemic. You might remember in 2020, after the initial difficulty of the spring, summer 2020, when the virus rates were low, there's a very big recovery in the world economy. So there's more optimism. And what you see now since the bottom in late 2020 is essentially this trend upwards. And again, if you divide that between late 2020 and late last year, the bond rate went from minus 50 to close to zero. Now, more recently, it's gone from close to zero to higher than the pre-pandemic level, and of course that connects to the new environment we're in now, which I'll get back to. Now, that risk-free rate is not available to everyone because, of course, when governments borrow and when the private sector borrows, risk becomes an issue. So one important metric we look at is the difference between what's the average rate governments in Europe can borrow at and that risk-free rate. And what you see here is before the pandemic, the average difference was around 40 basis points, 0.4. So if the risk-free rate is zero, the average European government borrows at plus 40. You saw in spring 2020, it spiked. Look at that spectacular increase from around 30 to 80. And this is the average. It's not the worst affected countries. But after the stabilization, and very importantly, after the introduction of Next Generation EU, which is summer 2020, then the spreads came down and they've been at lower than pre-pandemic levels since late 2020. So there's a lot of it with the PEPP, there's a lot of confidence that essentially financial conditions across the area would maintain fairly stable. Okay, so when we think about the earlier on I showed you we kind of altered the purchasing rate under PEPP over time. So how to think about that? So the right side summarizes what I just showed you. It shows you in orange the kind of trend up in the risk-free rate since late 2020. The blue line shows you the average sovereign spread over the risk-free rate. So in terms of financing conditions, you might say, well, the spreads look pretty stable. So there's no kind of spread issue to be concerned about. But you do have this trend up in the risk-free rate. And would you not be concerned that this would threaten the inflation momentum by leading to too excessively tight financing conditions? So the left chart adds the other consideration. The orange line is how weak was the inflation pressure. We take a medium-term perspective. So we defined the inflation pressure essentially as how weak is forecasted inflation compared to the pre-pandemic trend. Pre-pandemic inflation was low, but we expected it to pick up to 1.6 in 2022. Still not where we wanted it to be, but improving. So the orange line compared what we feared at each point in time in the pandemic compared to that 1.6 pre-pandemic baseline. And it showed you the shortfall was 30 basis points at the start. We feared inflation would fall to 1.3, which is quite far away from 2%. And we remained quite concerned until around June 21. And you see from June 21 onwards, that inflation gap came down to zero. And in fact, it turned around because now we think inflations will converge to 1.9, close to 2%. So in the context of an improving inflation situation, not all the way to where we want it to be, but less severe than at the start of the pandemic, that meant that during 2021, even though the interest rate was going up, the inflation problem was becoming less severe. And so the balancing act of how much purchasing to do had to balance those two considerations. And so every quarter, the world will be interested, what is the ECB going to decide? In spring 21, we stepped up purchasing because we felt the increase in yields was too rapid compared to the improvement in the inflation performance. Whereas in autumn 21, there's a rapid improvement in the inflation assessment and relatively gradual increases in rates. So then we stepped down purchasing in the second half of last year. Okay, let me move to the other side of it, the credit allocation. So this is, we ended up with a system where we said to banks, we will lend to you at an interest rate of minus 1%. Now, banks can deposit money with us at minus 0.5. So this seemed kind of experimental. Why are you lending to banks who in turn can make a guaranteed return by simply redepositing the money with you at minus 0.5? Well, the answer is they can make even more money by lending to firms and households. I don't think if you went to your bank, they would offer you, such a low rate as minus 0.5. They would charge you more. So they get a bigger spread on lending. So as long as they were comfortable with credit risk, they should make more money by lending to the real economy. So this is where there's a hand-in-hand situation. We were providing cheap financing, and according to these surveys, in fact, most of it did go to making loans. That was the dominant use of the money. This was made a lot easier by the fact governments around Europe offered credit guarantees. And they also supported corporates through all sorts of subsidies to employment, direct subsidies to corporates, so that their overall financing condition was not so risky. But again, this was an important part of how the overall credit conditions in Europe were maintained. And again, the logic was, because you only got the cheap interest rate if you maintained lending to the private sector, that reinforced the incentives to keep on lending. And so credit during this system remained in good shape. And you see this here, which basically reports on lending, because with banking, it's not enough to look at the interest rate. You should look at what collateral are they requiring, how tough are they being in terms and conditions. And what you see here is in 2020, the blue line is the amount of credit. It went up quite a bit. Firms really, because they had no revenue, selling nothing if you were in sectors that were affected, needing money to keep going. There was a lot of credit provided, especially in the start of this, and then over time, less so. And so you saw in spring 2020, the orange box is the net increase in loan demand, huge need to borrow. And that was met. So there's a success story here where the banking system, supported by credit guarantees and by telcos, were able to provide credit to firms and to households. And maybe in contrast to on the right side for the households, because households were staying at home, those who were forced to keep their jobs or had other subsidies actually didn't need to borrow in 2020. By and large, they were adding, so there's negative loan demand. They were reducing their debt, they were adding to their deposits. More recently with the recovery, there has been a pickup, people interested in buying houses and other things. And then in lending rates, this goes back to this concept of stability. Lending rates in this period basically remained stable. So again, in a world of instability with the pandemic, delivering stability in terms of the credit system, I think, was very important. Okay, so when you put all of that together and you think about the kind of what was the overall impact of PEPP, this is something the ECB tries to do all the time. Okay, no, are our policies effective? Now, we have a range of techniques to try and do that. And what you see here, maybe I'll just look on the right panel, which is the overall effect adding up over several years. And we think GDP would be about 2 percentage points lower without the ECB intervention. That's a huge number. Right now, we're more or less back to the pre-pandemic level. A normal recession is less than a recession with 2 percentage points. So adding 2 percentage points to recovery is a very big effect on the economy. In terms of inflation, we think the price level would be more than a percentage point lower without this. Now, this was an important contribution if you think about going into late 2021. Of course, it seems overwhelmed now by what's happening with the energy shock, which we'll get to in a little bit. But let me emphasize is that these are kind of models that are estimated on a long span of data, most of which is in normal times. So it doesn't really capture the crisis scenario we faced at the time. So here, when you do more conditional regressions, these quantile regressions, where you zero in on the tail. So we were in a tail risk situation in spring 2020. You could imagine you could have had much bigger effects. So here we're saying, look, if you had allowed a financial tightening under already recessionary conditions, there could have been a much bigger hit to the economy. Okay, let me come back to this idea, which I've already covered, I suppose, is that the inflation forecast, was below target before the pandemic. It had fallen in early 2020, and again, what essentially happened in the pandemic period is we tried to rebuild inflation momentum back towards target. And over time, it's the forecast. It took a while. It was stabilized initially, and only towards the end of last year did it start to pick up in a visible way. Okay, so that's really maybe I want to pause there, because that's essentially my retrospective on PEPP. That it should be seen as a success. It stabilized the European economy, which is very important. It basically made sure that the initial negative shock to inflation did not become persistent. It was reversed. In the written lecture, which is online at the ECB website, I kind of have a more extended discussion about how to think about some of that. But I think rather than to overtax you, I'll move more now to the second part of what I want to say, which is what's going on now. And what's going on now maybe can be summarized by this chart of the inflation data. So remember, before the pandemic, 2014 is when the ECB started using extraordinary measures to try and fight low inflation. And what you can see between 2014 and before the pandemic, inflation was very sticky, around 1%. The orange line is core inflation, which is defined to be more persistent. The blue is headline, which moved up and down around it, but basically was oscillating around 1%. So we had this narrative of inflation being well below our target, needing a lot of monetary intervention in order to make sure it didn't get worse, to make sure that stickiness around 1% didn't decline into stickiness around 0 or even deflation. And of course, we have one major economy, Japan, in the world, which has been stuck in it with a far worse low inflation problem for decades now. Now, what's happened very suddenly and very recently is we've had this very strong pickup in the second half of last year, and even more so this year. So the blue line shows you the strength of the pickup in inflation. The dotted line is basically what we expect in our March projections, which is further increases in the coming months, but then a reversal and inflation coming back to around 2%. We also see a pickup in core inflation, which is currently well above 2%. And again, this is projected to reverse and come back to around 2%. So why do we think this? Because essentially we think this is mostly a supply shock. It's an energy shock, which for Europe is imported. Europe imports more than 90% of its energy. And therefore, analytically, especially here in the chair of International Macro, you go to thinking about, okay, how do the terms of trade work? If Europe has to pay more for its imports to the rest of the world, that's basically a negative wealth effect. We pay more out. It's reducing our available income, and therefore it will have a negative effect on demand in the coming years. In addition to that, energy prices have a big level component, because essentially, you think about these are tradable commodities, oil, gas to an extent, and the very large surge in prices. So in the autumn, so at the bottom in spring 2020, oil prices were around $25 a barrel. Now, no one expected them to last at $25 a barrel. And, in late 2020 into first half 21, there was a recovery in oil prices, which you could just put down to, this is just a recovery in the world demand. In autumn 21, it looked like actually supply constraints, less supply than might be expected, were putting further upward pressure on oil and gas. And so oil prices were around $80 in November. They've been more recently around 120. They might have come down a little bit this week. So you've had this really big, spectacular, huge increase in energy prices. And then the second factor has been the pandemic recovery was quicker than expected. And so around the world, there's been these bottlenecks. Everyone wanted to buy a new car. But of course, when cars require a lot of semiconductors, the semiconductor industry was not ready, if you like, for this surge in demand. So I'll come back to that in a minute. So there are two temporary reasons. The energy shock has a temporary component. This mismatch of bottlenecks has a temporary component, which we don't expect to persist. So let me just illustrate that in a couple of ways. So one, this external shock, typically in recent years, the EU area might have had a trade surplus of around 2 percentage points. It's gone from a trade surplus of around +2 into negative territory. The fact it's negative is not important, but the turnaround is telling you we are now paying a lot more for imports. On the right side, that's another way to capture it, which is the income effect of this terms of trade movement. And this is just through the end of 21, it's not before the most recent surge, is on its own terms, the energy shock means we're paying about 4 percentage points of GDP more out on net for energy. So if someone says to you, you're going to take a 4% hit to your income, you have to think about that. Europe collectively has taken a 4 percentage point hit to its income in terms of what it needs to pay out for energy imports. The overall effect is less than that because simultaneously, it should also be remembered, Europeans are also doing well in the global market for goods. The prices that European firms are able to charge to global customers have also gone up. So the red box is the non-energy terms of trade, which has been improving. And by the way, if you read the news reports from the car industry, even though car production came down a lot last year, the share prices did okay because these firms charge much higher prices for their output. And so that's a countervailing force. Okay, then you might say, well, I mean, it's not just the price of energy, everything's going up in price. That is true. And so, but it's important to take into account every sector uses energy as an input. It's maybe 5 to 10% of the total cost base for many sectors. So most obviously for transportation, buses, trains, cars, and so on, that they all use energy. But it's also activities which are classified as services, like hotels. Hotels use a lot of energy to cook food, air conditioning, heating. So, across all sectors, you can imagine when you have such a big increase in energy prices, all prices are going to go up in the economy. So we have here, around now, it looks like it's around 0.7, so 70 basis points increase in what's called core inflation, just because of energy. Core inflation is running around 2.7 for the Euro system. So the fact that it's above where we want it to be, but a lot of that can be seen as the indirect effect of energy. Goods inflation is historically, I don't show pre-pandemic level, but we all have got used to goods prices either being flat or falling. So technological improvements mean every year you spend less on your TV, less on your computer and so on. So what's unusual recently is goods have gone up in price. Washing machines, fridges, etc. But the assessment here is also manufacturing uses energy, but these bottlenecks have also mattered. So the fact that temporarily there's been a mismatch in demand and supply has also pushed up prices. But over time, those mismatches should become less. And also with services, again, you should think of services as just being reflecting labor costs and so on. But the services industry also uses energy, and there have been mismatches. I mean, look around. We know restaurants, hotels, they just don't have the workers right now. So, the kind of recovery in the sectors most badly hit by the pandemic is leading to cost pressures as well. So some people say, well, why is the Fed already raising interest rates? And do they not have the same inflation problem as you have? So directionally, yes, but scale-wise, it's much bigger. So here, I just focus on core inflation. And what you see here is we have inflation above 2%, but not so high above 2. They have core inflation around 6, more than 6. The other difference with energy is, I mentioned to you, Europe imports 90% of its energy. The US is a big oil producer. On net, when the oil prices go up, America, it's pretty balanced in terms of the overall macro effect, because all the oil producing regions gain income when oil prices go up. So some parts of the US suffer, other parts gain, whereas Europe collectively suffers from that. And the reason why there's so much more inflation pressure in the US goes back to the fact that the recovery in demand in the US has been much stronger. So if pre-pandemic is 100, you see Europe basically approaching 100 again from below. A good recovery, but still all we're doing is recovery, going back to pre-pandemic. In the US, the size of the fiscal stimulus was a lot bigger. Very high transfers to households in different ways. So you see after the pandemic, demand for goods, not just recovered to pandemic, they went to 30% above the pre-pandemic level very quickly. So a really large increase in demand for goods might be expected to create some bottlenecks. So this is basically why we have a different situation. Now, there is a spillover because the American demand for goods means global manufacturers raise prices for everyone, not just Americans. Okay, so what I showed you here was we think inflation will decline, but we don't think it's going back to that stickiness around 1%. Our assessment is it's going to decline, but maybe we'll settle down near where we want it to be, which is around 2%. Why do we think that is? Well, basically, that essentially inflation models always have this self-fulfilling dimension, which is if people believe inflation is going to be 1, wages and prices tend to be set in line with that 1% target. If people believe inflation is going to be 10, then inflation will settle at 10 because everyone updates their wages and prices with that benchmark. So we look at what do people expect. And there has been a movement. Let me skip over this one and focus on this one. So one survey we look at is, well, what do all the forecasters around Europe think? The blue line is what they thought at the start of last year. So not that long ago, 1 year ago. And they had a peak belief around 1.516. So they believed inflation would settle down around 1.516, well below our target. And that's basically saying, okay, we believe maybe it's not going to go back to 1%, but we believe that Europe will struggle to get inflation to around 2. Now the distribution has moved to the right, where now the most likely answer is 2%. They believe actually after this, what's happened, that there's been maybe a reset of the inflation dynamic. And the reason why 2 is because we say we want 2. They believe that, if inflation is too low or too high, the ECB will respond. So this is why, there's a natural convergence to the target set by the central bank, because they know we can do something about it. The financial markets also trade inflation. You can buy an option or a contract which says, where the payout will depend, will it be contingent on the actual inflation rate. And you see here, before the pandemic, they were quite pessimistic. The blue line is the value of these swaps, and it come down to a level consistent with inflation being around 1%. That's an exaggeration because the orange line is, that's partly not what they believe, it's their risk. And at that point, they believed actually there was more of a risk that inflation would be even lower, not even higher. So there was an inflation risk discount, not a risk premium. What's happened in the last year is a big movement. So now the kind of unadjusted number is above 2%. And now there's a risk premium. So if you take away the risk premium, so they're fearful it'll be even higher. If you take away that risk premium, it's around 1.8, so close to 2%. So the markets, the forecasters, and we also survey consumers, and here in France there's a nice survey of firms as well. They're all suggesting we're not going to go back to the pre-pandemic very low inflation rate. The other ingredient why we think the inflation dynamic will be stronger than pre-pandemic is a greater optimism about the labour market. So at the start of the pandemic in June, we had the unemployment rate projected to go up to around 10% and stay high for a long time. That's what we feared would happen. And you'd also talk about concepts like hysteresis, scarring, and so on, that if you have people unemployed for a long time, it makes it harder for them to come back into the labour market. That's not what actually has happened. What's happened is there's been, first of all, unemployment never went up that much, and it's been coming down very quickly. Again, this goes back to fiscal policy, short-time working, fiscal subsidies, keeping overall demand in the economy high. And then we project it's going to improve even further. So we do think Europe will have a labour market where unemployment is around 7 or even in the 6s. This is not something we've seen for 40 years in Europe. And again, I'm looking at the overall unemployment number here. I know in different countries, unemployment for young people and so on, it would not be at that level. So this is always seen as important because it's very hard to have inflation pressure if the labour market is so weak, there's no bargaining power to raise wages. But in a stronger labour market, workers can look for wage increases in line with productivity and inflation, and that creates this self-sustaining dynamic. Okay, so that's kind of my kind of run through of where we are now. Maybe just in the last couple of minutes, because I do want to allow plenty of time for questions. Again, when we talk about the fact we're in the last day of net purchasing on the PEPP, that I want to come back to one of the principles of the PEPP, which is flexibility. So what I've said to you, in the end, we didn't have to use it that much. In the end, we basically were able to do the asset purchasing just in proportion to the size of each economy. But the reassurance provided by flexibility was very important, because in a monetary union, there's always the risk of a panic. Because essentially, there's a risk of a panic always around the world. But if you're in a country with its own currency, and if you get a bit nervous, you might say, well, maybe might be safe to move some money overseas. But you say, well, actually, I'm not going to do it because I face currency risk. What happens if the exchange rate moves? In a monetary union, you can move your money across borders without currency risk. And of course, that creates an intrinsic instability, which we've painfully seen in the European sovereign debt crisis of 2010-2012. So the ECB has always had to deal with this. We have one very successful intervention, the whatever it takes intervention of OMT at the time in 2012. We had an intervention that started the pandemic with PEPP, where we say, look, if needed, we will be flexible. And basically, when we decided in December last year that we would end net purchasing under PEPP now at the end of March, we reiterated that we do think flexibility is a special principle for conducting monetary policy in a monetary union, as we must focus on ensuring that policy is transmitted evenly to all parts of the euro area. So this is, and now we have more evidence to support that. The PEPP was successful. So it's shown that under stress conditions, so not all the time, under normal conditions it's not necessary. Under stress conditions, flexibility in the design and conduct of asset purchases did help to counter the impaired transmission of monetary policy and made it the Governing Council's efforts to achieve price stability more effective. So we concluded then that in the future, under stress conditions, flexibility will remain an element of monetary policy whenever threats to monetary policy transmission jeopardize the attainment of price stability. And this means that we are ready to use a wide range of instruments to address fragmentation. So this statement of principle, I think, was very important. And essentially, we've now got two particular implementations of that. One is we've said now we have this PEPP portfolio. We said we're going to reinvest, we keep it steady for the next couple of years until the end of 24. And in this reinvestment phase, if there is renewed market fragmentation related to the pandemic, we can be flexible in how we make those reinvestments. And then the second application just last week is when we rolled back some of the collateral easing measures that we took at the start of the pandemic. We also reiterated that in the future, the Governing Council reserves the right to deviate in the future from credit rating agencies' ratings if warranted, in line with its discretion under the monetary policy framework, thereby avoiding mechanistic reliance on these ratings. And again, that's an example where, if needed, if warranted, the collateral policy can be flexible. And this flexibility, we think, is very important to maintain stability. So with that, let me stop. Sorry for kind of taxing you with a long presentation and an even longer written text. But maybe if you have some comments or questions, it might be a good time.
Thank you, Philip. Thanks for this extremely clear, fantastic presentation of monetary policy across the pandemic and now the challenges. I think it could not be more clear. So I'm sure that there are many questions in the room and also for people who are following the event remotely. Please don't hesitate to send your questions. They will be transmitted here to you. So who would like to start? Maybe I can ask the first question. There has been a debate about the sequencing of the normalization of monetary policy with a different strategy in the US and in the euro area. So you have shown very convincingly that, of course, the inflation, the situations concerning inflation is much different across the Atlantic, but still there is a debate. Could you share your views? Of course, there are different impacts on the yield curve, on the through the also the returns of the interest returns of the banks, interest margins. Sorry, of the banks. So could you share your views and why the ECB has stick to the idea of reducing the balance sheet before hiking interest, even though the deposit rate is still negative, as you mentioned?
Okay, so there's a lot of different dimensions to this phrase of sequencing of monetary policy. What I would say, actually, by and large, there's a common framework for all central banks, which I think is being maintained, which is the first step is decide the calendar for ending asset purchases. That's the first step before you start thinking about raising rates. So with the Fed, they ended net purchases at the start of this month, and then they made a rate hike in mid-month. So the sequencing was respected, that they did end net purchasing before they started to raise rates. The Bank of England, correctly interpreted, also has that, and we have that. And it remains a pretty fundamental point, is if you were to raise the short-term interest rate while you were still purchasing long-term assets, you're saying, I want to push up the short-term rate and push down the long-term rate. And that's just really hard to work out. Okay, under what circumstances do you want to move the yield curve in that direction? So the more normal, I think, and it still remains true, is you tolerate a steepening of the yield curve. And you look here, I've just gone back to this graph here. Look at the size of the increase in the 10-year rate that's happened. And it's also true at 1 year ahead, 2 year ahead, the whole yield curve has been moving up. I make a reference to how to think about that in the written text. So the last bit that moves is the policy rate, the short-term rate. And so what we said is now, because of the new inflation environment, we've now revised what we think is the right calendar for asset purchases. So we in December, we said Q2 was going to be 40 a month. Now it's 40 in April, 30 in May, 20 in June. We've said the uncertainty is such, we don't know what the right number is for Q3. So if the inflation outlook remains where it is, we'll go to zero in Q3, sometime in Q3. However, if the inflation outlook weakens, and with the war, there's forces in both directions, we'll have to see the overall effect. We also retain the option to extend asset purchasing. Then what we said is after that, once that is over, then the decision about raising rates will come sometime after that. So there's no mechanical timeline, because it depends. I don't know what the autumn's going to look like. And then in terms of the first rate decision, we do have the criteria, which basically boil down to making sure we really think the medium-term inflation dynamic is going to stabilize at 2. Because we don't want to be raise rates and then only find out in the next meeting we need to reverse that. So making sure that you have a kind of a durable reason to move interest rates. And of course, now people want to know, okay, after that first rate hike, what are you going to do next? So what we've said is we're going to be gradual, and whatever, we're going to be guided by our 2% target. Last year, as you know, we spent a long time with a new strategy review. We've put out a lot of documents. Anyone studying monetary economics, we put out 18 occasional papers, each of which embeds hundreds of notes and memos. So if you want a kind of survey of any topic related to central banking, those are still pretty fresh. So then when we have to make decisions in the coming years, I'll just turn to my shelf. It's okay. We've studied this a lot. Let's think about what we do. So there's a lot of knowledge in the strategy review, which will help us set interest rates in the coming years.
Thank you very much, Philippe. So do you have questions? Daniel? Yeah.
Yeah, thank you again. It was illuminating, and it's a macro lessons, macro lecture for all the students, online and live, and it's fantastic. So I have two interrelated questions, really following up on what you just started to respond to Agnès. One of them is on the long run, real rate, natural rate of interest. We had this conversation with our French governor last week, but I want to hear your feedback on that. Whatever the expectations, we all understand that there is good reasons to believe that the inflation rate finally will stabilize around 2. Finally, after all the attempt to bring it up prior to the pandemic, but you don't see expectations of the nominal rates to converge towards 2. So it means that it's still below that, around 1 in your own expectations. And in fact, when you look at the Bund over the longer run with the swap, it's sort of come back down further down the road. So although in the US, it seems to be that the new normal is that the real rates will be slightly positive, It's not yet the case in Europe. So the question that I have is, how do you interpret that? I know that you've read a lot on the natural rate, so I want to hear your comments on that. I think it's fair to say that we moved from a world prior to 2008 to the subprime crisis, when real rates were expected to be around 2% in real terms, both in the US and in Europe. And it moved down to zero, to negative rates in Europe. It's going back to positive in the US, but not yet in Europe. So I see free interpretation, and I'll let you kick your own comments on this free interpretation. One is that it's a gradual process and the market is not still there, acknowledging the fact that we are back to normal. That would be a bad news, by the way, for the market if they were not understanding what you were explaining, that we are back to 2. The second interpretation is that we have an excess saving problem in Europe, so the real rate is lower. And the third interpretation, which is correlated to the second one, is we have a risk-free asset problem in Europe. That we have a shortage of riskless asset, which may explain why the Bund is lower maybe than the average if you go to the other extreme. So that's I want to hear your comment on that. Thank you.
Okay, thank you. I mean, so I wrote a Journal of Economic Perspectives paper last year, which tried to, provide a review of where are we with the euro. And actually, I have even a longer. So one of the key graphs is essentially this. So back at the start of the euro, and there's a lot of debate about interest rates in the 80s and 90s. Actually, many people believe maybe the real rate would be around 4. So if you add 2% inflation, you have maybe a kind of normal interest rate around 6. In 1998, we had the Russia crisis, we had the Asian crisis. Interest rates were a little bit below 6. And I thought I was getting a good deal when I got my mortgage at that rate. Then over the first decade, there's a trend down globally. So as you say, just at the eve of the global financial crisis, people believe maybe the real rate is 2, add inflation, and maybe a normal interest rate is 4. Now, the question is the real rate going to be 0, -1, let's say, and therefore the normal interest rate of being between 1 and 2? That's really the debate. So let me give 2 levels of answers to this. One, of course, for the market, anyone who has to value assets, you kind of have to take a stand on this issue. Central bankers do not. We will find out, because essentially what's going to happen is over time, and remember what I said earlier on, once you start using the interest rate as your marginal tool, it's a search process essentially. I mean, we will say, okay, we'll at some point raise rates. Is inflation sticky at 2, or is inflation pressure weakening? If inflation pressure weakens, it tells you that actually, unless it's a cyclical issue, you've gone too far. Equally, if you think, oh, well, I think the rate is some number, but inflation pressure is still big, okay, we need to keep on hiking. So we will find out, because we will be kind of doing it incrementally, marginally, and we don't need to know the answer now, because we're driven by whatever is needed to deliver 2% inflation on a sustainable basis. So that's my kind of little bit get out of jail answer to you is, I don't know what the number is. We will find out over time. But then if I jump over this, okay, let's debate the issues. All of the issues you've raised, I'm sure all play a part. What's interesting is that debate was there before the pandemic. It's here now. Maybe it's more productive to think about at the margin what's changing. One is the supply of safe assets in Europe has gone up with next generation EU, with more supranational issuance. These are priced around the French, somewhere between French and Bund pricing. So the collection of highly rated state securities available has been very importantly expanded by having more issuance. The fact that risk premium have been low has also, I think, improved the supply of safe assets. But as you say, I mean, we have two issues. One is the growth rate of Europe, because that's a fundamental here. That's not just about productivity, it's also demography. We have pretty weak demographic pressures here. So the overall growth rate of the economy might be very low for demographic reasons. But of course, that's a policy choice. It's a policy choice about how long people work, because of what counts as the growth rate of the labour force, and it's a policy choice about migration. Then, on terms of the desire for safety, the pandemic and now the war, is a reminder that disasters happen more quickly, more often than you would want. So you might think that, because again, a lot of the desire for safety is insurance against tail risk. It looks like this insurance is pretty important. So again, it'd be interesting to see, are people going to be more precautionary? Are they going to really want a lot of safe savings? Putting downward. So what on the other hand, we've got more active fiscal policy, which moves in the other direction. So I can see forces in both directions on North Star. And then on top of that, add the climate debate, which I think also works in both directions on North Star. So.
Thank you. So we have many questions. So if you don't mind to pick a few questions, and then you can group. So 2 in the room and also online.
Okay, very short. So at the end of the pandemic, we have inflation, but also high level of public debt. So to be very short, is there a new trade-off to deal with for central bank? Sustainability of public debt and inflation.
Yes. So my point was about the effect of the terms of trade on the fall in inflation that you have shown after the supply shock. So as you said, we expect the terms of trade to deteriorate, and this is why the inflation should go down. But how does this match with this narrative that the euro area has to become independent from external import to fight the bottlenecks and the supply chain disruptions that instead would bring actually a more closed economy? And we know in international macro that then you need terms of trade to deteriorate even more to get an effect on inflation.
That's Francesco.
We have several questions online. I don't think we'll be able to answer both, but one goes in the direction of Jean-Olivier's question by Giuseppe Balocchi, who asks whether preventing fragmentation of the bond market is not the same as distorting the price-finding mechanism of markets. And my own question as a follow-up to that would be, what is, if we think we need to make sure that confidence is maintained, what is the role of a new Stability and Growth Pact in that? Although perhaps that takes us too far afield. Then another question asks about what your view is about the significance of the most recent German and Spanish inflation data by Richard Bach. That question, and I would like to add to that I yesterday, when I prepared a little, I saw that German median household inflation expectations over the next 12 months are now at 5%, which I was surprised of, and I wonder if that what the significance of that is.
Thank you, Tobias. Do we have a last question? Yes.
No, a bit is a bit a generalization of the question by Jean-Olivier. So what do you think? We had this supply shock that came after the pandemic and all that, the ECB and governments done in Europe, and that changes, of course. What are the challenges of dealing with this supply shock in this situation against, if the war would have happened like, in 2019, for example. So a bit like connecting both parts of the
Okay, let me try to take all of those to a greater or lesser extent. So it's very important, as I was saying earlier on, to track expectations of financial market participants, of experts, but also of consumers and firms. And we also now have a new consumer expectation survey that we run ourselves, with an agency across a number of countries. So rather than looking country by country, if you look at this on a coherent basis, and I think that we're going to publish more of this in the coming weeks. What's interesting is, yes, there is this, but the actual inflation data is going up quite a bit. So I think consumers are very attentive to what's going on. But very importantly, from our point of view, is there's an upward revision about their inflation beliefs about for the next year, but much less revision of their beliefs about 3 years from now. So again, in terms of their belief, they also understand that because of the nature of the shock, it's concentrated in time. It's not necessarily going to persist, and so that I think that's important. But I think, given the scale of what's going on in terms of the inflation surprise, we have a monthly survey. It's going to be important to look very carefully about this. The issue which you raised about the overall response is interesting, because clearly near term there's a big fiscal response happening now, because of course when you have a very sudden, unexpected surge in prices, just saying, well, just live with it is not a reasonable fiscal policy response. So there's a smoothing of the shock with all sorts of compensation measures going on. But then there's this broader issue about the belief that there's going to be not quite hyper-globalization. Now, where in the spectrum from hyper-globalization to kind of mostly domestic we end up, let's see. But the big question from our point of view about it is, how quickly would that happen? Because, of course, relative price adjustments, if they happen relatively gradually, can be handled by in the overall monetary policy context, whereas it's very intense and it leads to basically big movements in GDP as well. Then I think it'd be different. But that is a good question. The issue about fragmentation. I mean, yes, you do have to assess that there's a basic multiple equilibrium dimension to financial markets. So if you believe that the financial market always prices fundamentals and there's never a self-fulfilling element, then you might say there's no case to fight fragmentation. But I think I personally would be convinced there is such a thing as self-fulfilling expectations. Absolutely. So if you take a stand on that. Let me say that what's happened in the last couple of years with debt is, remember, the counterpart to high level of public debt is very strong improvement in household balance sheets. Because what happened in the crisis in Europe was basically countries becoming collectively indebted. That's Daniel. I mean, if you have a situation where a country has so much external debt, it's looking at an indefinite prospect of running big trade surpluses every year to make a payment to the rest of the world. That's a very adverse macro prospect. You're going to see real depreciation, you have debt overhang, and so on. This is not the European situation. The sovereigns become more indebted, but the counterpart are Europeans. So if interest rates go up in the future, the government is paying more interest to European residents, who in turn will spend the money in Europe. So the macro dynamic is totally different when you have domestic public. When I say domestic, it's the currency area. It's not saying by nationality. It's within the currency area. So I do think this narrative that the public debt levels are so high, but it goes back to the or-star debate. In a world where you think the steady state interest rate is 6, you're kind of what you speculate about in terms of debt dynamics is very different if you think the steady state interest rate is 1 or 2. And I mean, again, in this Journal of Economic Perspectives article, this is, to me, the most fundamental point. All of the concerns expressed in 2012, 2013 about the future have been dominated by what's turned out to be basically this world that we live in of very low equilibrium real rates. And again, that's not central banks. It's these deeper real forces at work.
Thank you so much, Philip. I think this was a great morning with you, with a very rich presentation. Which so you will get the slides, I think, online on the ECB's website, also on the PSE website, and you can study them more carefully. Thanks very much. Thanks also to the Banque de France and to PSE for this event. And
thank you.
The best. So next year we meet and inflation will be 2%.
Very good. Okay. Thank you for all the questions. Thank you.
Thank you.